Good afternoon, everyone. It gives me great pleasure to welcome you all to the second of our webinar series around transaction tax, focusing on pre-IPO planning and reorganizations. This session follows an engaging webinar on corporate restructuring that we had hosted in January. As you're aware, an IPO is a watershed period in the life cycle of an organization. In fact, raising funds from anyone thrusts additional responsibilities and expectations, more so in the case of an IPO event. As an organization grows and say gets valued over $100 million, exit options for investors are very limited and in all probability limited to IPOs. Investors and founders are increasingly realizing that once they cross this valuation threshold, the likely outcome is going public. Our presentation today focuses on this part of the journey of an organization. Early and comprehensive preparation is key when planning a public fundraise event. While restructuring, governance, and organizing financial statements are important aspects of the public fundraise process, there are tax and regulatory aspects that play a vital role in moving towards this direction. Today's tax and regulatory framework also gives choices around the kind of markets and securities to tap for a public fundraise. We have in this presentation discussed some of the latest developments which can give direction to your public fundraise exercise as well. We have a Q&A box at the bottom of your screen that you can use to raise your questions, and time permitting, we will answer these questions in the Q&A session that follows. In any case, we will reply to your questions separately as well. Moving on to this slide around the key advantage of listing. The year 2022 has started with India as the 7th largest capital market. And in less than 3 months, the Indian capital market is now the 5th largest with a market capitalization of USD 3.21 trillion, surpassing the UK. This is the first time India has entered into the Elite 5. Which comprises of US, China, Japan, Hong Kong, and us. Raising capital over the last few years has become the trend for unicorns, and especially because they need to give exit to investors. There is also a need for growth capital for promoters to take over and acquire other businesses or grow into new geographies. In this presentation, we are focusing on taking you through key developments in raising funds from public in India or globally, including key considerations from the tax and regulatory perspective in this journey. These include segregation of surplus assets or properties or consolidation of entities in similar businesses to create stakeholder value, holding structure streamlining to enhance readiness for public fundraise, listing overseas and the new concept of IFSC listing, listing through the REIT or InVET mechanism, value creation and ESOP planning, and finally, diligence of tax positions before an IPO. In this slide, which talks about the IPO journey, while there are several things that we want to bring your attention to while planning for raising funds from public, the key drivers that we want your attention on are business growth and sustainability and the equity story. What story are you telling the market and or the investors? Which market to list, especially in context of value? Value assessment in itself and how investors perceive this value. And finally, the tax and regulatory framework and issues around the appropriate capital and the organization structure itself. And therefore, this focus of this presentation is centered around the tax and regulatory framework and the issues around capital structure. Though there are other elements as well, such as corporate governance, financial restatement implications, cost of raising funds, exit costs. We are here to bring to you the aspect of how tax and regulatory framework plays an important and key role in deciding your fundraise strategy. Going through a fundraise also brings additional responsibilities such as governance, disclosure, and continued review. As a prominent CFO of a recently listed company said in one of our discussions earlier, our performance is measured quarter se quarter tak. Moving on to the next slide. This slide, as you can see, talks of the listing landscape in India and how it is getting transformed. Till 2005, Indian companies had choice to either list in India or overseas through an ADR-GDR route. However, in 2005, the ADR-GDR route was amended to restrict Indian companies from raising capital through a foreign listing without a prior simultaneous listing in India. A total of 69 Indian companies have used the ADR-GDR route to trade their securities overseas, 15 through the ADR and 54 through the GDR route. The year 2022 saw interest in government permitting overseas direct listing, and an enabling amendment to the Companies Act was carried out. However, corresponding notification of countries that are to be recognized for this purpose, as well as the class of companies that will be exempted from compliance of Indian law around public offers, both under company law and SEBI, have yet to be notified. Considering the restriction on direct overseas listing, 2020 saw the listing in the US through what is known as a special purpose acquisition company via a holding company which was set up overseas. And this gained interest in 2020. Renew Power moved in this direction. Others, such as Freshworks, chose the traditional way to go through a NASDAQ listing process in itself. Having said that, the Indian stock exchanges also saw some of the largest listing of new age technology companies, such as Zomato and Paytm listing in India. However, this has also drawn the attention of regulators, particularly on issue pricing and disclosures. SEBI has taken cognizance of this and has also issued a consultation paper on listing of such companies. The objective of this consultation paper is to seek comments on the SEBI ICDR regulations, focusing on provisions relating to disclosures for basic issue price selection in office documents. Traditional companies, as you know, that are listed in the past were able to provide clearer guidance on critical accounting ratios such as EPS, PE, or the return on net worth and or the net asset value of such companies, including comparisons of such accounting ratios with their peers. However, these disclosures did not factor the business and revenue models of new age technology companies, particularly given that they may not have a track record or operating profits of past, and their models are centered around projections and or key performance indicators, which are not necessarily translated in revenue immediately. Therefore, such disclosures, SEBI and also a lot of consultants feel that such disclosures do not provide guidance to investors on what should be the basis of pricing of IPO of such companies, and therefore the need to assess and strengthen such disclosures for such companies. India, and SEBI in particular, is considering following the principle of disclosure-based regime, and the following factors are being considered. Of course, traditional parameters such as PE and or NAV, etc., still continue to be given weightages, but trends in key performance indicators over the past few years and the KPIs, how they get defined, will play out an important role in this. Valuations of what that company did in the earlier rounds of fundraise, as well as market conditions. So these would kind of play out as important factors that SEBI will start considering in pricing regimes for such companies as we go along. One of the reasons for new age companies to consider the US market has been the evolved understanding of value that such new age technology companies can fetch in the US as compared to any other markets. We hope as we get along that the regulator as well as the investor market in India evolves to be able to come to a comparable standing as is the US. Of course, market cap of India's capital market is perhaps 10% of what the US capital market is, but we are fifth now. So that's an important element that is playing out as we go along. The Indian government has also recognized the aspect and therefore has also moved towards a more liberal and innovative regime, particularly in the International Financial Services Center, that is the IFSC regime. The IFSC caters to customers outside India and deals with flows of finance, financial products, and services across the borders. This new concept is discussed in the ensuing slides in detail. Coming on to the next slide, on access to capital. What this slide captures are the choices that are available today for corporates to consider for public fundraise, either equity or debt in India or overseas, with the IFSC coming out as an interesting and new possibility. Alternative listing of or fundraise through innovative models such as the REIT or InvIT have also taken off in the recent past. As you know, the FDI policy amendment that was announced day before yesterday has also made FDI through the REIT registered with SEBI more attractive and liberal. FDI in REITs and downstream investments made by REITs are no longer restricted by the condition that applied to the real estate sector, which was limited to construction development and greenfield investments. This is being seen as a significant move that can boost FDI investment through the REIT for participating in yielding assets in India. We have discussed the REIT and InvIT listing in the ensuing slides. I now call upon my colleague Shubham to take up the ensuing slides.
Thank you, Sridhar. Good morning, good afternoon, good evening, everyone. This slide, we are going to talk about the segregation of assets or immovable property or consolidation of similar business. In context of IPO, it is very normal for the corporates to reorganize their business in a manner which creates maximum value to the stakeholders. That is basically the promoter group, investors or shareholders or employee. Not at the only time at the time of a fundraise, but also subsequent exit which they are looking for. In particular, the non-core assets and immovable property, which is not related to business, are usually hived off to create such efficiency. Similarly, for various reasons, it is common to have same or similar businesses operated through various legal entities. Further, there can be situations whereby multiple businesses are not consolidated under common group holding company. All this permutation and combination will require relook on the existing structure to either segregate or consolidate, as the case may be, prior to the IPO or a public fundraise. For this purpose, the mode of transaction can be broadly bucketed into three buckets. The first one will be the NCLT route, which is basically the merger or a demerger. The other one will be the regulator approval route, which is generally a fast track merger or a demerger or a conversion or a succession. And the third will be generally a private transaction, such as lump sale or itemized sales. There are basically 5 top elements which significantly drives what is the mode of transaction you are going to take or any corporate is going to take to reorganize the business, either it's a segregation or consolidation. And those top 5 is generally what we refer to as T cube and C square, where T cube basically stands for uh, transaction cost, time, and tax attributes, where the C square attributes to cost and the capital or a cash segregation. Now let us understand each of this element in a bit. The first very important point is the transaction cost, which is basically the tax or a stamp duty cost which we are talking about. For undertaking any reorganization, it's an important factor. Recently, the clarification on the no depreciation or non-identified intangibles by the Finance Act 2021 is an important factor, because that becomes a key factor on this any reorganization which you are going to take place, because it's directly impact the effective tax rate of the acquirer entity, which also entails the additional cash outflow. But it gives a much more certainty now rather than uncertainty which was earlier there. Further, generally the transaction costs are significantly lower in case of a NCLT or a regulator approval route in comparison to a private transaction. Generally, in the private transaction, which is the slum sale or itemized sale or acquiring assets, you generally don't get the tax neutrality, both from an income tax perspective, also from an indirect tax or a stamp duty perspective. The second very important factor, which is basically the ease of implementation or a time factor, is that when you are taking this reorganization and what is the time to do this transaction or a reorganization which is going to take place. Similarly, in the Finance Act 2021, the clarification of the slum sale or a slum exchange is a welcome move and provide a certainty to that aspect, that there is no more ambiguity that whether the slum exchange is taxable or not. However, we all know the slum sale or a slum exchange is a much faster transaction compared to any NCLT approved or a regulator approved transaction. So just for example, if we have to compare the timelines between a merger or a demerger or a slum sale, generally a merger or a demerger in last 2-3 years because of the COVID times, this is stretching between 6 to 9 months. More so, even if you have the transferor and transferee company in the 2 different states or in 2 different regions, this timelines can be stretched much more longer. Even in the case of a fast track merger or demerger, the timeline is the minimum what we are seeing is between the 3 to 6 months. So there is a significant timeline which is involved in doing the transaction, and of course, without talking about the paperwork which is required. Whereas a private transaction such as slum sale or asset acquisition can be done in a much faster manner, and if it is within the group, it can be completed in 30 to 45 days. Third very important perspective is the tax attribute. When we talk about tax attributes, what we basically is referring it to that what is the unexpired tax holiday or effective utilization of carry forward or unabsorbed depreciation, which is post consolidation or a transaction which we are looking at it. This also include that what is the mode of transaction which we are taking, and is there any post transaction condition has to be satisfied. So let's take an example that in a situation where the transferor company having a significant carry forward business losses or unabsorbed depreciation, and it also qualifies under Indian income tax law for carry forward of such losses. The tax neutral reorganization with continuity on such tax attributes in the surviving entity becomes a crucial factor there, which may not be possible in the case of a business transfer or asset transfer. Similarly, the post-consolidation conditions for continuity of such tax attributes are also very important element before the corporates finalize the mode of segregation or consolidation or a reorganization. Fourth very important part is from an investor or a shareholder perspective, which basically means that is there a continuity of cost of acquisition and the period of holding depending upon the residential status of the stakeholder and the company under reorganization. For example, the merger or a demerger provides a continuity on the cost as well as the period of holding in the hands of a shareholder, whereas contribution of the asset or a shares with settlement in stock by the surviving entity will lead to extinguishment of the period of holding and historical cost, which basically is lead to a significant tax outflow if you are looking for an immediate transaction or an immediate fundraise where the stakeholder is planning to exit. Fifth very important factor which has to be kept in mind is capital reorganization or the cash settlement, how you are going to, when you reorganize, how you can settle the transaction. Swap versus cash settlement helps also to attain twin objective of excess cash which is there in the system can be extracted, and also how can you reorganize your capital structure prior to do a public fundraise. Though from a tax perspective, this may have a similar impact that what mode of consideration you are paying, more so with the clarification coming on the slum exchange. But this is an important element on the overall scheme of things, whereby settlement can be made by in cash or a stock, and you can time your exit at the appropriate time when you want to exit. With this, let's move to a next slide. In this slide, we will try to understand with the help of a case study, which we had worked in the past, that what type of structures which we are talking about, or what type of mode of this one, which is basically the driving factors to decide this. The first example, which is on your left-hand side, is on the segregation or consolidation of business for proposed IPO. There are two promoter group entities, B Co and C Company. Both are operating company. A company is a holding company. The business in C Company is significantly smaller in size, but very similar to the business which is operated in the B Company. Operating of similar business post public fundraise can be a governance issue, and then there is a need for consolidating the business at least. Merger of C Company with a B Company is ruled out due to existence of a non-core asset such as investment or removed property in C Company. In this situation, the only possibility which you have is basically a hive off of a C Company business to B Company, which can be achieved by demerger or slim sale. However, in the given structure, we also had to see that that at the time of IPO, if promoter is looking to exit partly, then in that case, the promoter holdco, which is A Company, will participate in offer for sale, and the sale consideration which will come will basically be parked in A Company, and subsequent upstream of that cash from A Company to the promoters, let's say in the form of dividend, will be taxable in the hands of promoter at the rate of 36%. To overcome this situation, this demerger of business of C Company can also be used as an opportunity to reduce the overall taxes. Alternative, what can be done? The C Company Y business can be demerged to B Company, and rather than issuing the shares from B Company to the promoters directly, A Company, which is the 100% holding company of B Company, can issue redeemable preference shares to promoters pursuant to demerger, which will also qualify as resulting company as per provisions of the Income Tax Act. Subsequently, on the transfer of B Company shares by A Company at the time of IPO under offer for sale, the cash which goes and sits in the A Company can utilize this cash to redeem the redeemable preference shares from the promoters at significant premium. What is the advantage of this is basically is that as this redeemable preference shares are issued pursuant to a demerger of Y business, the period of holding is of the shares in C Company is eligible, and the RPS will be considered as a long-term capital asset. Also, the pro rata cost of the C Company share, to that extent, it will be attributed to the redeemable preference share which A Company has issued to the promoters, and thereby significantly reducing the promoters' tax from 36% to 24%. Now, moving on to the another example, it's on the consolidation. In this example, which is in the right side, the promoter owns A Company and LLP, which is engaged in very similar business. A Company proposed to be listed, and hence there is a need of consolidating the business into A Company. Traditionally, the business transfer from LLP to A Company is done by way of cash or stock settlement. However, this will not be a tax neutral, and the promoters has to upfront pay the taxes. The other way to achieve the same thing can be that the alternative, the promoter can consider succession of LLP business to A Company, which is tax neutral subject to the following conditions, like assets and liabilities of firm relating to the business immediately before the succession become the assets and liability of the company. All the assets and liabilities should be recorded at the book value, and partners should not receive anything other than the stock from the consideration in the form of a stock, and the promoter should hold 51% of the shareholding in the A Company. This view is possible that succession of LLP business without conversion of LLP into company will also qualify as a tax neutral transaction as per 47(13) of the income tax provision. This has been supported by the judicial precedent also. Also, even if the assets and liabilities, since the assets and liabilities are transferred at the book value, and if their assets are, and if the conditions are violated in the future, so for example, the 5 years holding of 51% violated, there may not be any tax implication for the simple reason because all the assets and liabilities have been transferred at book value. This view can have a significant weightage in the case the business transfer does not have any immovable property. And this has also been supported by the various judicial precedent in the past. With this, I'm moving to the next slide. Holding structure streamlining is an important topic which has a significant bearing in the pre-IPO structure. The efficient holding structure is not only helps to reduce the overall taxes and exit, but also flexibility on raising public funds. Few of the drivers which has to be kept in mind when we are planning for the holding structure streamlining is the very important piece is exchange control valuation and regulation and valuation, which in general terms be known as ODI FDI structure. In recent times, the Reserve Bank of India has been averse to any structure that has a resident owning a foreign entity that in turn owns an Indian entity. In other words, ODI or FDI structure. There are very limited ways to overcome this restriction, and it is recommended that an inverted foreign-owned entity is set up at an early stage of the business and well before any fundraise is contemplated. New proposed outbound draft regulation proposes further restriction on this, and hence, if there is a long-term plan to list overseas, this has to be planned upfront rather than keeping it for the later point of time. Choice of entity is another very important factor for promoters holding and non-resident investor from upstream of profit as well as the exit perspective. There can be a significant tax arbitrage and regulatory bottleneck if this is not planned appropriately. Financing of growth and acquisition. Efficient holding structures generally allows multi-layered financing and leverage facility at investment holdco level as well as the operating level. This is important element to squeeze out excess cash with minimal tax payout and also provide flexibility for organic and inorganic growth in the growth. Domestic versus international. The holding structure should have a flexibility to raise public fund in India or outside India. The typical examples such as structures can be the resident promoter holding an Indian holdco, and that Indian holdco is holding an intermediary holdco, let's say example Singapore, and that Singapore holdco is basically holding a global operation or a global subsidiary. This type of a structure basically provides the flexibility or efficient use of cash within the group and efficient exit and a fundraise opportunity at multiple levels. That is basically you can do the fundraise at the India holdco level or an intermediary holdco level, which is in Singapore, or at the operational company level itself. Single entity versus multiple entity. Typical multi-entity structures are preferred where risks needed to be isolated at business level or license are unique. This is also done where the conglomerate is engaged in multiple businesses with different risk and reward to have flexibility on fundraise or exit, etc. The multi-entity structure is also preferred in case of JVs. However, even in case of a multi-entity structure, there is a need to have a common holding structure for value consolidation and eliminate tax inefficiency for fund utilization. So these are the few key drivers when you are looking at the holding structure from an investor and from the shareholder perspective. Now let us try to understand this with a live example that what exactly we are meaning here. This is an example where a global group is actively considering to list a company in India. So there in this structure, the non-resident promoters and investors have a holding company, AFCO, let's say at Singapore. And that Singapore owns a global structures, the global subsidiaries, including India as a subsidiary. In addition to the investments, AFCO also operate in Singapore and Middle East. In order to get listed in India, the value consolidation has to happen at India subsidiary level. Further, the SEBI regulation requires that Indian company has to be in existence for some time, the new ICO cannot be then done. So we have to do this structure with the existing ICO, which have the track record and everything. Now, in order to achieve this, what can be basically done? The FCO can set up another subsidiary in Singapore, let's say new FCO, and infuse funds equivalent to FCO business and overseas subsidiary value. After doing this, FCO will transfer the shares of new FCO at fair market value to India subsidiary. And ICOM and Indian company or Indian subsidiary will settle this transfer by way of issue of additional shares to FCO. If ICO have any excess cash, that can also be infused in new FCO with the existing cash which has been infused by FCO in the first step, and the ICO infusing additional cash in new FCO. New FCO can buy the business and the subsidiaries of FCO, which is a global subsidiary of FCO. This will result in basically India Holdco holding the Singapore company along with the business and also with a global structure. Having said that, the only piece which has to be also seen that that when there is a transfer of overseas subsidiaries from FCO to new FCO, we need to see the local taxes of the respective countries, that if there is any tax implication being there, and if it is manageable, then this way the inversion can happen and ICO is ready for to be get listed in India. So with this, I will request Sridhar to take us to the next topic, please.
Yeah, thank you, Shubham. On the next slide, which describes SPAC versus IPO listing, we have attempted to capture the features of listing in the US through a SPAC mechanism versus a direct IPO listing in India. These are not comparables, but just to give you a sense of how the markets, how the various regulators and markets look at it. At the moment, SEBI does not offer a SPAC listing in India, and therefore an Indian listing is still bound by the traditional form of an IPO or an offer for sale. Now, what is the concept of a SPAC? Very briefly, a SPAC is a special purpose acquisition company that is a public blank check shell company, usually incorporated in a jurisdiction that does not have a simultaneous listing restriction or a requirement in that home country. For example, in Cayman Islands or BVI, with a defined window of time to seek a merger or a takeover of a private target company. And therefore that company then becomes public. The SPACs in themselves do not have any business operations or even a stated target for acquisition when they raise the funds. And they are expected to facilitate a business combination with an existing operating company. Typically, SPACs have 2 years to complete an acquisition, or they must return their funds to the investors. And their units are priced in a manner where there is a set of common shares and warrants, which are either fractional or whole. And when an acquisition happens, these convert into equity or are redeemed, depending on whether that investor wishes to continue in the merged entity or otherwise. Most transactions, therefore, also require additional funds for the redemption and or for further strengthening the value of acquisition of the target itself. And these come in through what is known as a private investment in a public entity or a PIPE investment. Typically, what are the advantages that you see in a SPAC listing over a traditional IPO? Is that the listing process in itself is faster, which means it can be done as quickly as in a 3 to 4 month period as against a 9 to 12 month period for an IPO. You could expect better valuation, especially if you are in a high growth sector or a deep tech sector or a renewables or e-commerce businesses. Of course, this comes with its own downside of higher scrutiny and diligence of such companies post de-SPACing, and therefore there is no shortcut in getting a better valuation than actually creating more value to all stakeholders. The more efficient process of actually dealing with everything through one party is also a significant element as compared to an IPO where you have to do multiple roadshows that require convincing multiple investors and analysts, etc. And last but not the least, there is flexibility to negotiate as well in terms of the ability of the target, that is the company which will de-SPAC and get listed, to negotiate a stock price and other deal terms as part of the SPAC acquisition process itself. Now, the Indian government on its part is aggressively promoting a domestic listing, and this is finding favor amongst Indian unicorns. Recent DHRP filings by Navi and EbixCash are examples of this interest. One important tax consideration that plays out in case of a resident holding shares of an overseas listed company is the fact that the period of holding is akin to that of an unlisted company shares. That means you need to hold the foreign listed company shares for at least 24 months to get the long-term capital gains tax rate. In comparison, the shares of a listed company in India get the long-term capital gains tax rate if they are held for 12 months or more. An IPO listing in India under the offer for sale, however, is still taxed as if these shares are unlisted while they get listed in the process. And therefore, the 20% rate and the expectation to hold shares for more than 24 months still applies in that situation of an offer for sale. Now, as mentioned earlier, a direct listing of the Indian company overseas is still under consideration by the government. And hence, at the moment, this is not a possibility. Listing overseas, therefore, requires an overseas holding company, which becomes the vehicle to list itself overseas, with India and other countries operating under it. Such a listing can be achieved through a merger or acquisition by a SPAC, or through the traditional means of undertaking an IPO in NASDAQ. Moving on to the next slide, which talks about SPAC listing in itself. And there is an example which we would like to kind of bring out here. Now, under the income tax law, a de-SPACing carried out through a merger or a demerger of two foreign companies that derive substantial interest from an underlying Indian company is tax neutral. From a resident shareholder's perspective, demerger is therefore the preferred mode of de-SPACing, given the more liberal interpretation of tax neutrality between the merger and a demerger position. However, the elephant in the room is the Indian exchange control law, and we'll come to that in a moment. The other de-SPACing modes that usually get considered are inbound merger, which means merging the foreign company, which is usually an SPV under the SPAC or the listed entity, into an Indian target company, or considering a domestic merger of an Indian SPV, again under the SPAC, owned by the SPAC with the Indian target. So that's a domestic merger. And both of these above possibilities are tax neutral as far as the exchange of shares is concerned. The other way to do this is emanating from the example that Shubham had taken earlier, which is a share swap, where the swap is the other way around, where the Indian company's shares are swapped for shares of the SPAC entity, or where there is a traditional buyout through a slum sale mechanism that is considered, which means an Indian subsidiary set up under the SPAC, which then takes over the business through a slum sale from the Indian target entity. This means cash out, and this obviously means a tax impact at the time of sale of such business and or a share swap. Outbound mergers also have a similar tax impact, where if an Indian company were to merge into a foreign company, you would still have a tax impact on account of the exchange of shares not being tax neutral as compared to an inbound merger. Now, coming to the elephant in the room, and Shubham mentioned this briefly in his previous slide, Indian exchange control law will not or may not allow the resident promoters to own foreign entities, which in turn own Indian companies, which is typically known as the ODI, FDI structure or round tripping. Now, RBI has explicitly come out with a position that such structure requires its prior permission. And in practice, they have been averse to granting approvals for structures which only have India business under the overall structure. As things stand today, therefore, an overseas listing, whether through a SPAC or directly, requires an overseas holding company which is owned, if not entirely, but certainly predominantly by non-residents in that equation. Having said that, a resident portfolio investor is able to invest overseas to the extent of USD 250,000 per year in acquiring portfolio interest in such overseas companies. Now, on the issue of whether an option granted to the resident shareholder while continuing in the target listed company post its merger or acquisition by the SPAC is something that is being considered and is in vogue in the current context of scheme of things, where the resident still continues to hold his share in the Indian target while getting an option to exit from the Indian target at the fair value of the listed SPAC or the overseas holding company of the SPAC. And there, of course, valuation rules play out as they speak. But as long as the Indian resident gets a higher value than what is the base value of the Indian target, the exchange control laws allow for such optionalities to be built in. And also the fact that a non-resident is acquiring these shares makes it efficient for the SPAC entity to finally hold 100% of the Indian target at the most appropriate time when the resident investor is looking to delist to exit. Of course, dual listing through the ADR GDR mechanism is still available, and there is clarity in taxation of non-residents that hold such ADR GDRs to the extent of the exemption from capital gains when they sell such ADR GDRs to other non-residents. For a start, the government can even consider allowing ADR GDRs of Indian companies without the need for domestic listing in India, and that could kind of be a very simple move to allow for direct overseas listing through the ADR GDR mechanism. Moving on to the next slide, which talks about IFSC listing in particular, and in particular the IFSC SPAC as well. So the government of India in July 2021 allowed a SPAC to get listed in the IFSC. And among other things, the following possibilities are permitted in the IFSC. The first is an IPO of equity shares of an unlisted issuer, which includes a startup or an SME. And such unlisted issuer could be an Indian company, a company incorporated in the IFSC or a foreign company itself. The second possibility is a secondary listing of its equity shares, of any such entity's equity shares, Indian, IFSC or foreign. The third is an IPO of equity shares by a SPAC. Again, the SPAC could be domestic, in IFSC or foreign. And the last is listing of other securities, including debt or depository receipts. So a very comprehensive set of regulatory regime has been put in place that allows for such possibilities through the IFSC list mechanism. Conceptually, IFSC is supposed to list its securities. All of these are denominated in foreign currency only. And therefore, even if you are a domestic company, your securities are treated as if they are denominated in foreign currency. RBI also has clarified that an investment by a resident, whether corporate or individual, in an IFSC is to be treated as ODI, and all such investments must be made in foreign currency under the respective window, which is ODI or LRS, depending on which window you are applying. Similarly, SEBI has also clarified that an IFSC listing would be governed by the regulator, the prescribed regulator being the IFSC-A, that is IFSC regulator. And there is no further role of SEBI in such listing. Now, regulations that were notified in 2021 also provide a comprehensive regulatory framework, which include listing of a SPAC in the IFSC, like I said. However, the restriction on round tripping, that is the ODI FDI structure, still applies to investments made by residents, even though it is done through the IFSC. So an IFSC is also seen as a one-way highway. So what are some of the salient features of particularly of SPACs that get listed in IFSC are similar to what a SPAC model is in the US as well. The offer size is not kept as big as what is expected in the US, and a SPAC can have an offer size of up to not less than $50 million. The sponsor should hold at least between 15 to 20% of the post-issued paid-up capital of the SPAC. The minimum subscription of shares by the in the public should be at least 75% of the offer size, and therefore a SPAC in behavior, again, there's a 2-year period for the SPAC to be unwound if it does not get an appropriate target that it seeks to acquire. In essence, the SPAC in IFSC can be used by a resident sponsor to acquire overseas targets, or a non-resident sponsor to acquire an Indian target. So it's a one-way street in that sense. And round tripping of a resident sponsor acquiring an Indian target still has adverse consequences under the current RBI regulations. From a tax point of view, the non-resident, for a non-resident, there is a sweetener which the tax law provides by exempting capital gains on transfer of specified securities listed on IFSC exchanges. And for this purpose, specified securities include foreign currency denominated equity shares. However, for residents, there is no such exemption, and therefore this will be taxed in the normal way, as if these are listed securities in India. The concept of security transaction tax, commodities tax, or goods and service tax, and stamp duty in respect of all transactions carried out in the IFSC exchange is also exempted. And to that extent, there is a lesser cost even for residents to use the IFSC IFSC regime itself. Prima facie, the IFSC regulatory framework has been drawn up to attract foreign investors, and in itself, it does not offer advantages for residents to consider such listing. Of course, it does allow a direct listing of a domestic company in the IFSC, and to that extent, it's a step in the right direction, moving towards permitting direct overseas listing in itself. If we move to the next slide, the alternative investment vehicle around REIT and InvITs is what we are explaining in this slide. Essentially, a REIT or an InvIT, let me get to the InvIT first and then to the REIT. The coverage of asset class in the InvIT class in itself is kept wide, and it includes transport and logistics infrastructure, roads, bridges, ports, shipyards, railway infrastructure, energy, electricity generation, transmission and distribution assets, oil and gas pipelines, water sanitation infrastructure, solid waste management infrastructure, social and e-commerce infrastructure, educational institutions, sport infrastructure, and hotels above 3 stars, and cold chains, and affordable housing as well. So the list is expanding, and InvITs have an important, are getting to be seen as an important mode for raising funds from public for financing infrastructure. The sponsor of an InvIT can be a company or an LLP, and for a REIT or an InvIT, both the asset value should be over 500 crore and the minimum offer size should be over 250 crore in the initial offer. The units of an InvIT can be both listed and unlisted and can be offered to residents and non-residents freely. In case of a private placement of units, the minimum investment value is kept at a threshold of INR 1 crore for each unit holder. Listed InvITs or REITs can have all kinds of securities, including debt securities issued, and unlisted InvITs can issue any kind of instruments that are prescribed in their charter. To that extent, the kind of returns that you would expect from the units can be structured in a most appropriate way to maximize the return for the investors. In case of a dual layer structure where the InvIT or the holdco is owning the asset, the real estate asset, the REIT asset in itself, such holding should be at least 51% in controlling interest of such SPV or holding company, and all such REIT or InvIT should hold at least 90% of their assets in completed InvIT assets. For REITs, this is kept at 80%. For InvITs, this is at 90% in the InvIT class assets. Both REIT and InvITs are permitted to borrow from financial institutions to meet funding requirements of their SPVs. And in distribution, the REIT or InvITs are required to distribute 100% of the cash flows that they receive from the SPV and at least 90% of the net cash flow to investors on a half-yearly basis. So therefore, investors get a distribution on a regular basis from these yielding assets, and the REIT and InvIT in itself is a pass-through, is seen as a pass-through vehicle, pass-through vehicle for efficient repatriation of asset returns on assets. Now, there has been as you know, we mentioned this earlier, that there is a recent announcement under the FDI policy which has freed up REITs in themselves from conditions attached to real estate sector, and therefore FDI into REITs is also likely to pick up in view of this alignment of policy to permit REITs to acquire yielding assets without the conditionalities for foreign investments. And this is likely to grow as an investment vehicle in the coming days. Now, if we move to the next slide, we'll exemplify the element of why a REIT or an InvIT makes sense purely from a tax perspective. What we have focused on is how returns flow through to investors and sponsors. So as you see, if I was on the left-hand side looking at a normal dividend upstreaming from SPVs to the promoters, such dividend upstreaming to the promoters is taxed typically at the rate of 35.88% now, with some leeway on surcharge, etc. On the other hand, if you look at the right hand side structure, an upstreaming of dividend from the SPVs to a REIT or an InvIT, and further upstreaming to the unit holders, is structured as tax free. And therefore, this combined with the fact that at an initial contribution level, the promoters in themselves do not pay any tax while these assets get contributed into the REIT or InvIT, in itself makes the structure very tax efficient from the structures from the investor's perspective. There is obviously further sweetening on account of the relaxation in the FDI policy on REITs. So if we could come to the next slide, which talks of stock options, and we've kind of switched gears significantly on this point here. This is an important element as the concept of stock options and the value creation that potentially is possible for stakeholders in designing such an instrument is significant. What we have captured in this slide is the outcome of a survey that GT had recently undertaken, and this is going to be published in a report on how equity linked instruments and how ESOPs are leading the way in India. The report, our report, is based on a fairly intensive research of 700 companies across different sectors, and provides you that insight and market benchmarks that business leaders have actually adopted to consider long-term incentive instruments to attract, retain, and create ownership for critical talent. This report should be out shortly, and we hope you like reading this. Now, what is evident is that almost all industry segments and businesses ranging from technology to pharma to FMCG have caught on to and recognized the that a stock option tool is a very important value creation element to be considered in the life cycle of a company, whether it was pre-IPO or post-IPO. In fact, companies are going beyond traditional definition of employees to compensate stakeholders such as contract workers, vendors, independent directors, and consultants with such incentives or similar incentives, I would say. For startups, having an ESOP is a given and does not need any convincing. There are some innovative structures such as classes such as employee stock option welfare trusts based offerings that are also being considered by listed and unlisted companies, which have their own nuances. If we were to move to the next slide on what creates value actually, at the core of any such plan is its design. Now, in designing an appropriate stock-based compensation strategy, the answers to the questions that we have enlisted in this slide is really what makes the most value value accretion for such employees and or to stakeholders. Now, depending on what answers that come out of these questions, an appropriate plan is structured and drawn out, which creates value to all stakeholders, not necessarily limited to employees. Now, concepts of such as golden shares as well as sweat equity are also getting recognition in the value creation that they bring to the table. From a tax point of view, at a high level, taxation of stock options qua the employees is at two stages. The first stage is when the employee exercises the option that are vested to him. In this example, the time period between the sale price, between the share price when it is at 150 to 750 to get the share is the exercise price. And at this point in time, the employee has to pay tax as perquisite on the difference between the strike price, that is 120 in this example, and what the value of that share was at the time of exercise, that is 150 or 750 as the case may be. This part is subjected to a normal TDS regime where the employer is expected to deduct this amount while paying salary to the employee. And usually when an employee exercises, he may be potentially out of cash and may need financial support to be able to acquire these shares. This is where a trust form of model may also help in funding this expense in itself. From a company's perspective, the benefit in itself is treated as if it's an employer's expense, an employee's expense, and therefore it's a deductible expense in itself. There has been some controversy on the value of that and how it goes in valuation, but at a principal level, it's getting established that expense should be allowed on such a payout, or a deemed payout as we call it. Once having become a shareholder or an owner of the company, to the extent of what he gets, the employee is free to hold these shares and sell in the open market. And usually he waits for an IPO event to do this. In this example, if the employee were to sell the shares post IPO at 1,000 rupees, he would pay capital gains tax on such sale. And if he were to hold these shares for more than 12 months, then he potentially gets the long-term capital gains tax rate on disposal. Let me now call upon Shubham to take us through to the end and talk about tax positions and IPOs. I think we have exceeded some time.
Thank you, Sridhar. We will quickly finish this off, and since we don't have a time for Q&A, we will respond to the Q&A separately to the audience who has put that in the chat box. On the diligence of tax position before IPO, migrating from a private company to public company is a lifetime event, and which also means that there is additional compliances which will be required. Private companies typically prepare their income tax provision once in a year, whereas the listed companies are required to do it in a quarterly period. And this is a resource intensive process. Whether it's a particular tax reduction taken or a decision not to report revenue in a particular period, financial statement only reflect a tax position that is more likely than not to be sustained if challenged by a tax authority. Tax provisions are a tricky part, including the deferred tax, because it can almost mean 1/3 or 1/4 of the company's profit before tax. And hence there is an assessment which is required before a company is planning for an IPO or planning for a fundraise to assess the critical tax positions which has been taken by the company. Discovering an uncertain tax position post IPO can lead to a significant fluctuation in the effective tax rate. Other negative implications such as the fluctuation or the variation in the stock can be also be there, including the possible restatement of prior financial reporting can also be a consequence out of this. So in preparation of for public company or for a fundraise, reporting requirement, business should perform a thorough review of tax position taken on prior year's tax return to determine if there are uncertain under a more likely than not criteria and take necessary steps to address and document such position. Further, as part of a DRHP or a RHP process, or even in wherever, even in the overseas listing, if you are doing, there is an expectation from the regulator that the material tax uncertain items are specifically called out, including any open tax assessment and a possible outcome based on the extent provisions as on the date of such assessment and the judicial precedent on that behalf. So as highlighted before, considering the expectation of quarterly reporting, the company should also have a team and a resource ready to address the challenges, including the review of the follow-up steps to avoid any surprises from a tax perspective. And hence, though not very keenly taken, but this is one of the very important piece which while going for tax assessment, the company should look into this. So with this, we had just completed our presentation. As I discussed earlier, we are going to get back with the answers for the queries which has been raised. Trust all of you find the presentation insightful, and we thank you for your time today. As you are aware, we are hosting a series of 6 interactive webinars dedicated to various aspects of a business lifecycle, covering the inception, growth, exit stage, where we share practical insight on the inside in the various facets of M&A transactions, acquisition under IBC or deal structuring, and more. We'll be back with our next series of session in the month of May, and look forward all of you participating again. Thanks for joining us today, and look forward to again interacting with you in the month of May. Thank you.
Thank you. And we will be responding to your queries separately so that we don't miss any important ones. Thank you for your participation, and we hope you enjoyed this webinar as much as we did presenting the topics. Thank you.